Welcome back to Gimme Some Truth. We have a very special episode today because we're going a little point-counterpoint. I don't know if it's too young for you, Syl, but Stan, you probably know this. I am dating you a little bit. McLaughlin Group, you remember that? Where it's
right.
Just, yes, back and forth. Or
at least the Mike Myers parody of it.
That's true.
SNL.
Does that reference mean anything to you?
Nothing.
There you go. Perfect. McLaughlin Group. So we're going to do a little point-counterpoint. So we have an investment committee here at Walkner Condon, and both of these gentlemen are members of the investment committee, as am I. But I'm just the referee today, really. Sometimes we have a little bit of disagreement inside the investment committee. Sometimes we have different viewpoints about the market, and that's exactly what I think you'd want out of your advisors. You don't want everyone working lockstep. And here also, we don't have one just voice. So as a book club, we're reading this Bill Gross, the Bond King right now, and you found out with PIMCO that Bill Gross was running the whole show here at PIMCO, and there were no dissenting voices, really. The investment committee was kind of just a sham. Here, that's not the case. We have differentiation in viewpoint, and so all following the same objectives of trying to get the best investments for our clients in designing portfolios. So you're seeing two people that are intimately involved in the interworkings of the investment committee and the investment selection. So we'll start out first. We have two gentlemen here. We'll call one of them Sunny Syl, and we'll call one of them Skeptical Stan. Thank you for wearing your navy blue today. Kind of show
I'm a little blue.
Storm clouds are on the horizon, maybe a little bit, and Syl looks like he does every single day. So he looks great as always. Syl, currently the S&P 500 is trading at a trailing price-to-earnings ratio of approximately 29, well above the long-term historical average of around 18, amid concerns over stressed valuations. Why do you believe stock prices can continue to rise or at least stabilize despite these elevated multiples?
Yeah, I mean, multiples are going to be a challenge, and I think U.S. stocks are expensive. I also don't think that P's need to expand. So the P ratio doesn't need to actually go up for the market to go up, right? So if you look back to 2021, which was really the previous highs in this market, P's were actually higher than they are today. And yet, the market's up 30-something% from, 2021. So, I think P's are a challenge. They have been for a while. I think they are part of the reason why maybe the U.S. is not my favorite market in the world, and the S&P 500, I think, is going to face some challenges relative to other markets. I think there are better opportunities elsewhere. But, I think there's enough happening in terms of, things that could start this next leg of the rally, that, we could be in a situation where P's are not necessarily, something that's going to stop markets from going up.
Stan, what are your comments with some of the stretched valuations we're seeing, particularly in the U.S.?
Well, I mean, I think Bitcoin has no PE, right? So
that's true.
There's
no E there.
Do they even matter
There's
anymore?
There's only P.
There's just P and helium, right? So, I mean, Syl, I agree with Syl that valuations are frothy, right? I'm not convinced that we're in the right economic and policy backdrop for earnings to push the E so much that the PE doesn't have to go up further and expand further for the markets to do really well. I think as one of HBO's favorite sitcoms was titled, it's time to curb your enthusiasm, right? So maybe expectations need to be tempered, to say the least.
That's fair. And do you think it's safe to say that at this point, Stan, that tariff, ramifications and repercussions haven't necessarily been priced in, and also that tariffs are at a much higher level than we've seen in the past and are definitely a drag on what we're probably going to see for earnings?
I mean, it's clear to me that the market got spooked, and rightfully so, on Liberation Day when we got a completely new definition of what reciprocal means, right? Because it wasn't, well, you've got 10% tariffs, we're going to impose 10% tariffs. It's like if your trade balance is 90% of the trade between the two of us, we're going to tariff you 90%. You know, just craziness, right? And I think the market got spooked by that. It is amazing that, you know, a couple of months later, we're hitting new all-time highs, right? But no, you know, I think the big beautiful bill and all of the tax cuts and especially the accelerated depreciation, you know, provisions that, you know, our stimulus, right? We're getting fiscal stimulus for the first time at large levels in quite some time. And I think that kind of counterbalanced the market, but curb your enthusiasm, because no sooner did he ink that thing over the weekend than he started, you know, throwing out some new higher tariff levels on, you know, Mexico, the EU, you know, our arch enemies, right, in the world, right, the EU and Canada and Mexico, right? So, and then, yeah, that's a little skeptical and sarcastic, but, you know, it is a concern. It concerns me greatly. You know, it is, I have an economics degree, and you don't need to have an advanced economics degree or an economics degree to understand that you've got demand for a good and you've got supply for a good, and a tariff shifts the supply curve in a way that raises price and reduces output. So it sounds like stagflation if you apply that across the board to the majority of your trading partners, right? And when you are in an economy that, you know, we don't have global supply chains are complex, right? So even American manufacturers get hurt by these tariffs. I think that's one thing that people need to understand. The Ford Motor Company has to import from like 20 different countries to make an F-150. So you could be as patriotic as you want, you're hurting the Ford Motor Company, right? And you're raising the price of the F-150 eventually, right? I think for a while you may not see that in economic numbers, but again, it's basic economics. Unless a good is perfectly price elastic or perfectly inelastic, the burden is shared, right? And there will be less goods imported, and they will be more expensive for the consumer. And that spells problems for a global economy that is intimately and in a very complex way webbed together, right? You can't overnight change that and just create vertical integration in your own country. It doesn't happen.
Not overnight. You're right.
No.
So
years.
Yeah, it will take years to bring some of that supply, you know, here if that is the goal. Syl, you know, do you share in sort of that? I saw the inflation rate ticked upward a little bit recently, today's print, but then it was followed by as expected. So do you think that the tariff, you know, when we all talk about the kind of taco thing that goes on with Trump, he backs down and things like that, do you think the tariffs are a little overdone? And do you think we're going to see a lot of that show up in economic data, or do you think it's kind of more of a blip than a huge problematic thing?
I mean, I think tariffs are going to be a problem for a lot of companies, and it's going to be a big challenge for sure. You know, at the same time, I think, you know, the U.S. economy is still pretty strong, very resilient. I think, you know, navigating its way around bad policies is kind of what the U.S. economy does all the time. It's kind of its full-time job, to be honest. Yeah, I think the question is, you know, can it survive higher tariffs? I think that's a fair question to ask, right? And I think the early signs so far are pretty good. And I'm saying this as someone who came into this year, as you know, feeling kind of pessimistic and feeling like we might be facing a higher likelihood of recession this year. There's been some good stuff happening under the hood. I think in particular with the U.S. consumer, that's been a lot more resilient than I thought initially. So the way I think about tariffs is this. At the end of the day, tariffs are just a tax, right? You can make it sound as sophisticated and glamorous as you want. At the end of the day, it's just a tax increase. I mean, it's nothing else. And if I look at like the monthly Treasury statement, for example, so far it looks like it's a tax increase that amounts to about $27 billion of extra money coming into the U.S. Treasury every month. So that number is probably going to go up. But just to compare that with the income tax. Income tax is about 300 billion or so if you combine like individual and corporate. So to me, it comes down to this. Can the U.S. economy survive what's effectively turning out to be like a 10% relative tax increase, which may increase to being like, call it a 20% relative tax increase. So at the end of the day, if you really try to boil it down to its more, fundamental components, that's the question we're facing. Can the U.S. economy survive a 20% tax increase? And I think, there's a good chance that it might avoid a recession. And I think there are signs that are showing that there's a very good chance that we might avoid recession this year.
And the tax bill that was recently enacted then as well, Stan referred to it as stimulative. Do you share those same viewpoints that it's likely to be stimulative?
100%. And I think it's a big part of my thinking. It's a big part of why I can't be bearish, really. And again, I don't know which way the market is going. It could go down, it could go sideways, it could go up. But I do have a bias, and my bias right now is that this market's going up. And a big part of that is that we continue to see, fiscal stimulus being implemented on a very, very large scale. And whether that is right, wrong, sustainable, long-term, those are all valid questions. But the bottom line is this, if we've learned anything from observing markets since, COVID and maybe since even the Great Depression, the Great Financial Crisis, we've learned that the market loves this narrative of, fiscal stimulus, especially if it's combined with lower interest rates and easy money. And, it looks like we are getting all of that. So I'm seeing a lot of the COVID playbook being repeated this year. And, we saw what happened after COVID, with markets. And, if we get anything resembling that, we could see that there's a risk to the upside, right? I think we could see it could be very good for risk assets.
Stan, do you feel like risk assets are the only assets to be in right now anyways because of the inflation story that potentially is impending there as well, that there's no place to be but stocks or crypto perhaps because bonds aren't going to give you that sort of yield that you need. Government bonds now, we're printing so much money that we no longer, can we even repay those government bonds? What sort of yield are you going to require on those? And so therefore you got to run to stocks and there's almost a melt up there.
As challenged as the U.S. stock market looks, one could argue that the U.S. bond market could be more challenged, right? Right now, we've damaged the brand, and the dollar has taken its biggest drop in like 4 decades in a 6-month period, right? Our treasuries depend on people all over the world, governments all over the world, sovereign wealth funds all over the world, wanting to own dollar assets, right? This has propped our stock market and our bond market and made both thrive since the Great Recession, right? What concerns me most, I'm in agreement with Syl, and I think we both agree that we like foreign assets more than domestic assets, even though obviously he's telling a pretty good story about stimulation here in the U.S. But the dollar story kind of scares me a bit because, especially with treasuries, right? So think about the idea of putting yourself out there if you're a domestic home player here in the United States. The U.S. treasuries perceived as the safest bonds in the world and out yielding foreign bonds by a fairly good measure throughout most of this period when the U.S. interest rates went way low. European rates went negative, right? Japan went negative. But if you're a foreign investor, imagine an environment where you were getting 4% yield on your treasuries, but in your currency you were also getting a 10% kicker, or 7% kicker. But imagine there were years where your treasuries in your currency, which is the only currency you care about, in your spending power went up 10% or more in some years, right? That sounds fantastic. But now imagine the reverse, right? You have a 4% Treasury bond that's paying you out coupons for the next, 20 years, and your currency appreciates 10% against the dollar, right? So you basically are locked in at a 6% per annum losing proposition, if that, is a new long-term trend. And that's what I'm worried about, right? Because this could cause a lack of demand for new issuance of U.S. bonds. This could also cause an exodus from, large ownership block of people that own treasuries. So no matter what the Fed does, remember the Fed can only affect ultra short-term rates directly, right? And traditionally, ceteris paribus, all else being equal, that's going to spill over to longer-term rates. But if the dollar is challenged and there is, a repatriation of investment money from U.S. assets into foreign assets, and a new love affair with foreign assets here in the United States as well, right? It won't just be them. They'll be like, wow, now if I own European bonds, I'm getting the kicker, right? Or if I own, Canadian bonds for that matter, maybe I'm getting the kicker now. And so I don't want to own those U.S. bonds. So there's a real danger that we could end up in a situation where long-term rates are significantly higher. Debt service would become way more expensive. At the same time, we just balloon the crap out of our debt again, right? So I see the storm clouds of potential crisis and problems, right? It doesn't mean I want to get out of U.S. assets, guys. It means that, that diversification is, the case for serious diversification has never been stronger over, a significant period of time than I think it is right now, right? I think it's time to think about alternative assets like gold. I think it's time to think about bonds, but I think it's time to think about diversifying your currency exposures so that maybe you can own some bonds that get the benefit of a potentially falling dollar, right? And I think that, as far as, the weak dollar can also be good for the economy. I'm sure Syl would point that out as well, right? So it's not all a horrible story. It can kind of offset the tariffs in some ways, and help U.S. companies when they're doing business and make their profits better when they're doing business elsewhere, perhaps, right? Unless we're in a trade war, and then all bets are off, right?
Syl, do you believe that, or do you worry about the risk of a protracted long-term dollar devaluation?
Yeah, I mean, I think what we're seeing with tariffs and with the change in trade policy is, it's clearly hurting the dollar. And I think there's a real risk that, we're going to see an acceleration of this de-dollarization trade because, I think there's so many countries around the world that are, going to start looking for alternatives. Now, where I don't fully align with Stan's view is I think the dollar could decline even as rates come down and even as the Treasury market continues to function properly. So I'm not seeing, at least in the short term, I'm not seeing a sort of all-out bond crisis that, would combine dollar weakness with, much higher yield in U.S. Treasuries. I actually like Treasuries right now. I think rates are probably coming down. I know there's a lot of concerns about the Treasury market, but at the same time, if I look at the 10-year yield, it's down year to date. So, the market is not telling you that there's any real concerns there. If you look at, the Chicago Fed's financial conditions index, it's at some of its lowest, so most loose levels that it's been in the last few years. So there's no signs of stress in the U.S. bond market. If you look at high yield spreads, they're extremely tight. So I'm struggling with this idea that under the hood, there's a Treasury bond market crisis that's brewing, yet yields are down, and there's really no signs of stress in the credit market anywhere. So, I think Treasury bonds are fine. I think, there are a number of initiatives that are happening in the background that, could help rates come down, could help liquidity in Treasury markets. And we talked about, the initiative to, for example, to lift or remove the supplemental reserve ratio for banks to hold treasuries. This is something that was done during COVID temporarily. That had a massive, massive impact on the Treasury market. And, it increased liquidity, yields came down. It's created some massive incentive to...
But what happened after that to yields?
Well, yeah. I mean, the point is that at the end of the day, it was the same playbook, right? It's you create an incentive to for banks to fund your fiscal expansion.
Right.
And,
So you love the 2020
and the market,
playbook,
and the market
but
goes up.
not
right?
necessarily what happened in 21
Again,
and 2.
No, exactly. I mean, look, I'm a long-term inflation hawk, right? You know that.
Mm-hmm.
I've always said so. But we were talking about the rest of the year here, and I think if we're thinking 6 months ahead, I think rates are probably coming down. I think treasuries.
It's certainly possible. I mean, I think things that happen in the short term with currency or interest rates very hard to predict.
Yeah. And I think, I think there's a lot of ways that, the treasury market, and I know people worry about foreigners buying treasuries and things like that, but most treasuries are held and bought by domestic investors. That's the majority of who buys treasuries. And so it's very much a captive market. And, I think there's ways to create incentives. And I think, some of that is already being worked on in the background. And I think that's going to have an impact. And we can't ignore it. It's worked in the past. I have no reason to think it's not going to work again.
Syl, I have one final question for you, and I'll pose the question back to Stan after too. You wrote a piece earlier in the year that was talking about momentum and how momentum is basically all you need. And I think momentum has, in 2025 has been extreme to the downside and now to the upside. We're seeing those animal spirits rekindle. When just a few months ago, we were all talking about, are we going to see another, are we going to see a deep recession or a big correction or bear market? And so, we look at the Mag 7 and the AI story, and we see all these different stocks. And, the Mag 7 stocks are spending, a lot of the Mag 7 companies are spending incredible amounts of money. Just their CapEx is just through the roof on projects that you would think, oh my gosh, this is truly going to be life-changing, or just complete throwing money into a dumpster and letting it on fire. And I'm not sure which yet.
Yeah.
Either Zuckerberg is a genius or holy cow, he can spend money. So I guess, when we look at U.S. stocks versus foreign stocks, when we look at the Mag 7, I just don't see this global story in these European stocks. Like, what is going to replace that? Replace any of the Mag 7 in there and give you those big rates of return and potential high upside in there and around this AI story. I don't know. I'd be interested to hear your comment on that.
At some point, if AI is truly successful, then it's gonna benefit a lot of different types of companies, right? If you think about it, we had this discussion last year. If AI really works, then some of the companies in emerging market, for example, stand to benefit the most because they're very constrained in terms of like talent retention, for example. Those are countries that suffer from a lot of brain drain and stuff like that. So suddenly if you put AI tools, in their hands, and then that opens the playbook a lot, right? So there's lots of ways that if this AI revolution does happen, that it's not going to be investors buy the AI companies to benefit from AI. At some point, AI has to have a broader impact than that. And look, I think it's true that we've been getting used to this idea that, it's only the Mag 7 and it's only tech stocks that can ever really move with that much force and momentum. But I think, if I think if you go back to days around 2008 and prior to 2008, it wasn't always like that. There were times when emerging markets, for example, were the hot stocks. And actually, if you remember, prior to 2008, the great theme at the time was this whole idea of decoupling, where only emerging markets could ever produce this kind of returns. And there was this whole idea that billions of Indians and Chinese consumers were being lifted out of poverty. And it was the most compelling, most elegant bullish case you could make, and it was combined with soaring valuations and great performance. And eventually it all unraveled and things changed. And it's true that I think this year, for the first time, we're seeing signs that it's not all about the Magnificent Seven, that there are other stocks out there that they can underperform. And I think that may be the beginning of something bigger. And I think we could see a more sustained trend of outperformance by areas of the market that have been unloved.
Stan, if AI ends up coming to fruition as far as really being able to reduce expenses at a company, make people more productive, and is a growth story, and maybe not to the extent that some believe, but say that it's a 8 out of 10, how are we going to go into a more recessionary environment with that sort of backdrop? Do you think it still could exist where AI could do really well and yet stock prices don't keep up?
Well, I mean, it's hard to wrap your head around all of the ramifications of that type of potential productivity leap, right? It comes at a time in human history when wealth disparity seems to be, it's kind of got that 20s feeling, that early 30s feeling to it, doesn't it? Here, and I mean, I hope that the benefits of AI spread out from the Mag 7 to the CREP 493, right? The S&P would benefit greatly from, improved breadth. And, some of the adopters of AI and some of the dinosaurs are coming out and starting to roar right now. I looked at the 1-year return of Oracle, for example, right? And I'm thinking to myself, my God, is Larry Ellison the richest man in the world again? Because it was like up 200% or something crazy, right? So, the concentration in the S&P, is at those 30s and 50s and 90s levels, right? I mean, I didn't create that by myself. Other people, have brought that to my attention. And the cap-weighted S&P's performance in all three other eras was not impressive going forward, right? It was underperforming for a significant period of time. Can this time be different? I don't know. I mean, we're all at least old enough to remember how many times in the 90s we heard the phrase, this time it's different, right? And that is the type of phrase that makes the hair on, the back of my neck stand up a little bit and get really uncomfortable with things. Possible? Yes. But it's also possible that, that this is the ultimate, game changer, and there will be boom and bust periods, and there will be retreats from all of that CapEx, and there will be, and it will be recessionary, and it will be, unpleasant for, a lot of investors sitting on too many gains to feel like they could ever sell some of these things, right? And then there will be AI 2.0, and and then that will be bigger and better, right? So, I am not a pessimist by nature. I am an optimist by nature, and I have telling nervous people around Liberation Day why they should still own their investment in the triple Q or believe in the U.S. stock market. I'm like, just it's always difficult to bet against innovation.
That's right. I think that's a great.
And let's wave that red and white and blue flag as we've been poo-pooing on the U.S. We are a juggernaut when it comes to innovation, right? But let's not be so naive as to believe, like Syl said, AI can level the playing field here. And we shouldn't believe that their innovation won't thrive elsewhere going forward as well, right? And maybe, maybe this type of, trade antagonism is just the kick in the pants that other countries and regions, it's a wake-up call, right?
Yeah.
And who knows what it's going to look like. I pray that I don't believe that we had a golden age in the 1870s to the 1930s, and that that was the best time to be alive. Now is the best time to be alive.
Yeah, I would agree.
And
with you.
I'm just hopeful that 10 years from now, when I'm older and more skeptical, that I'll still believe that this is the best time to be alive ever.
I will agree with you that it's the best time to be alive as long as AI 2.0 doesn't become Skynet. So, exactly. So
then all bets are off too.
There we go.
It won't matter what the S&P is doing.
Thank you for joining us this episode of Gimme Some Truth. Hopefully you got a little something from Stan and Syl here. We'll call them Skeptical Stan and Sunny Syl. We'll see how it shakes out the rest of 2025. Be sure to leave some comments, make some suggestions for future shows. We're happy to have the two of them back on again to battle it out even more. So thank you for your time today, and thank you for watching our episode of Gimme Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.